Hi, everybody. My name is David Walker. I'm the director of the Shasta-Cascade Small Business Development Center. Thank you for joining us for tax planning and preparation for sole proprietors. Our presenters today are going to be Joseph Dorko, who's a tax consultant, and Joe Rodola, who's the lead consultant here at the SBDC and has been since World War I or something. He's been here a long time. If we can move to the next slide, Joe. A little bit about us so that you're aware. The Small Business Development Center is a nonprofit organization, and we provide confidential, no-cost advisory and training services to small businesses and entrepreneurs. We're funded by the Small Business Administration and the state of California. But you should know that there are SBDCs all over the country. There's just under 1,000 of them. So if you are not in Shasta County or Trinity County of California, which is what we cover, there is an SBDC near you. All you have to do is use Google, and you can find the SBDC that's in your area, and we encourage you to do so. It's a service that you've already paid for through your taxes. So, thank you for paying your taxes, by the way. Go ahead, Joe. See what else we got. This is what happens when you get lawyers involved, everyone. We have a disclaimer now, and I'll give you the highlights. The information in here and all the supplementary materials, everything you're going to be hearing does not constitute professional, financial, or legal advice. No registrant should act or fail to act on the basis of any material contained in this webinar without obtaining professional advice specific to your situation. And all of us here specifically disclaim any liability, loss, personal or otherwise, which is incurred as a consequence, directly or indirectly, of the use and application of any of the information presented in this webinar. So there. That's what we get to say at the beginning of each one of these. So at this point, we'll get going. I'm going to turn it over to Mr. Rodola, who will then turn it over at the right time to Mr. Dorko. All yours, Joe.
Thanks, David. I appreciate it. Well, good morning, everybody. Joe Rodola here, the lead consultant, as mentioned over here at Shasta-Cascade. We do cover Shasta and Trinity County. And as you can see, yep, older than dirt. How about that? Been a credit guy for 45 years. So involved in making loans for 20 of the 25 years I worked for a financial big bank at the time. I have owned my own little consulting business for 10, and I've been an advisor here for both Superior California Economic Development and SBDC for the last 8 years, shortly to be 9 as we change the calendar, thank goodness, to 2021 here shortly. So welcome to this class. We're going to split the presentation into 2 parts. I'm going to start with the tracking and the potential for utilizing either QuickBooks or Excel to track income and expenses. And then the other Joe Dorko, is our tax guy. And he's going to take it from preparing all that information to what we're about to do come April 15th of next year, which is to report to the IRS. So again, tracking income and expenses, why do we do it? Many reasons, well, all these reasons, of course, come into play. But obviously, you need to know if your business is profitable. You need to know that as quickly as possible. So we always suggest that you start tracking the income and expenses from day one, okay? That allows you to make adjustments when needed. And also will tell you when you can finally make money for you, and especially in a sole proprietorship situation. You need to know when you can start making draws. So by knowing what the income is, or knowing what the break-even point is in your business, and your expenses, which tell you how much money you have to make to break even, got to know that on an ongoing basis. Basically, as a small business owner, I think weekly minimally, you should check to see where you are And you can do so utilizing the tracking devices that we're about to bring up. Obviously, QuickBooks is a well-received accounting tracking program. We have a wonderful trainer here, Rebecca, who has many classes that are offered. And by the way, you can get to all our classes. Our final slide will give you the contact information to check all these classes. We got webinars like nuts, okay? So a lot of free information that we can offer you. And Rebecca does a fabulous job in teaching and training on QuickBooks. What we're gonna do, what I'm gonna do today is I'm gonna go with the easy down and dirty method. For those of us that, for instance, me, when I started 10 years ago, this is the method I used as a consulting firm with very little expenses working out of my house to track my income and expenses on an ongoing basis. And it works well for a lot of sole proprietors. And obviously the final reason that you need to know about income and expense is how much tax you got to pay, which is Joe's forte. So ways to track income and expense on the P&L, profit and loss, or income statement. Things to think about. How complex is your business? In other words, if you're a corporation, or if you are an LLC, limited liability company, and you've gone to all the effort to split out your personal from your business, it's going to be a little more complex. You know, you may have a bookkeeper, you may have an accountant, you may have QuickBooks in some fashion, whether it's the online version or you go out and buy the software and put it on your computers. You know, but if you're a sole proprietor, especially someone with very limited expenses, I don't write off my house. I work out of my house, but I don't write it off. Okay. So basically I have no rent. I don't write off utilities. There's a way to do it, which Joe will explain, but suffice it to say, I don't do that. I keep it very, very clean, okay? You may not need QuickBooks specifically. If you don't have employees, it makes it a lot easier to do what we're about to talk about as well. If it's just you, okay, that run the business. In other words, in my particular case, if the good Lord decided to call me up, you see my background, Space, the Final Frontier, I was a Trekkie, so I'll admit it. The good Lord called me up above the stars today. My business ceases to exist. So no employees, again, might also drive you to a simplified or more simplified tracking. What forms of payment do you receive? Do you only take cash? Do you take credit cards? All these things also might drive it. Will sales be immediate? In other words, I do something for you, you give me money. Or do I do something for you and you send me money when I bill you at the end of the month, right? So that is delayed pay or accounts receivable. I won't go into that much, but suffice it to say, some people do have accounts receivable. And do you need bookkeeping software? Okay, so I'm going to talk about, if I can do this appropriately, let's see how good I am at this. At sharing screens. This is where it gets a little bit freaky for me. Let me know if the income and expense screen is up.
It is up.
It is up. Look at that. Technology and teaching the old dog new tricks. Here we go. So here's a nice little tracking device. We will send this to you. If all of you put your, which I believe you did, your email address when you signed up for this particular class, with this webinar, we'll send you a blank one of these as an attachment, okay? It's just a simple tracking device. It's the one that I used when I started my business 10 years ago, 2010. May 7th It's one of those life-changing things that you do in life that you always remember. So May 7th, 2010, and I started using this template that I pulled from the internet. Okay, I won't lie. I didn't even create the Excel spreadsheet, but I sure as heck like to use it. So what you do is, you can see here, you got it all pre-set up. It's got all the sample formulas to do the calculations for you automatically. So all you have to do is fill in the blanks. So total sales or revenue or income, call it whatever you wish, monies received in that particular month goes in the monthly boxes. So as you can see, we have $1,000 in sales in January, $1,200 in February, and so on across the board. Every time you put in an income, it automatically then would show as a gross profit, depending on whether or not you had what's normally called cost of goods. So what's cost of goods? Cost of goods is normally set aside for retail style or some manufacturing, obviously, style businesses. Service businesses, for the most part, I know I don't have any cost of goods. So if this is mine, I have total sales, no cost of goods equals. In this particular case, we're doing a small retail business, okay? So a retail business is going to buy product. You're going to probably buy product at wholesale prices and sell them at a higher price, retail, and that's how you make your money, right? So in this particular case, we sold $1,000 worth of product, whatever that product was, that cost us $200 to buy, basic, okay? So that leaves us now with a gross profit of $800 at the end of January on line number 6, item 3. Then you've got other expenses, right? You've got rent, maybe, you've got utilities, you got telephone, insurance, you might have professional services. All these are changeable. So depending on what business you have, you can simply cross out a line. You know, if you didn't have, well, everybody's got advertising, but you know, if you didn't have a loan, you could change line 18, number 15 here from interest on loans to something else. You can always name these individually any way you wish. So we have rent, $500. It goes all the way across, obviously, because rent normally doesn't change. Utilities would probably change, but for sample purposes, we just said $50 a month, okay, across the board. Same thing with telephone. Telephone probably going to be different every month, or you know, maybe pennies up or down. But we said the telephone $75 a month, insurance $40. That normally stays the same. Sometimes insurances are paid quarterly, so you'd only have a quarterly expense here. Some insurances are paid semi-annual or twice a year, then you'd only put it in the months in which you were charged. In this case, we're showing a $40 monthly insurance cost. Your business license, if you are required to get one, happens once a year. So, you know, in this case, the business license is $50. Say you're a city of Reading, $50 business license in June, boom, there's your expense. Advertising, don't forget that you're going to have some, and this advertising could include anything from, you know, you might consider your business cards as advertising. You might consider pamphlets or trifold flyers as advertising. Obviously, if you use Facebook advertising or pay advertising on TV, if you really got a lot of money, all that advertising goes in place there. We're doing $20 a month. Office supplies only expense when we buy them. And one of the expenses that are often missed, I think Joe will go into a little more detail. Many of us, I teach classes, and I teach classes off-site from my house. In fact, it's one of the normal rules and regulations of a home-based business is not to have people driving to your place. It's a lot of reasons why you don't want that to happen, right? First of all, these are strangers for the most part. Second of all, they don't, normally want to have everybody know where you live. And thirdly, business license city of Reading is going to say, hey, you have people coming to your place? The answer is always no. You're either going to use a place like Drop In, which is a rentable office space north of town, or the EDC has rentable office space, or I teach classes at various sites. I used to teach a class at the library. I taught a class at United Way. I taught a class at the John Boudet Center in Shasta Lake and used their facility, okay? So every time I drove to those places, I tracked the mileage. Why is that important? If you do not write your automobile off through the business, which you can do with a corporation or an LLC, mileage, great deal. It's averaging 55 to 56, 57 cents a mile over the last several years, depending on the year. It changes normally each January. So at this point, I had 56.5 cents a mile. You drive 150 miles, it adds up. And that takes into consideration wear and tear on your tires, oil changes, price of the vehicle, et cetera, et cetera, et cetera. And you get to write that off of your gross sales. Pretty cool, huh? Because when you get to bottom line, what you pay taxes on is that last number, net profit, okay? Net profit. And we'll be going there in the next phase of this particular calculation, but suffice it to say that bottom number 26, line 29 on the Excel sheet, that's what the IRS cares about for the most part. Unless they audit you, they'll have you prove the rest. But suffice it to say, I've been in business 10 years. My wife's been in business 20. Knock on wood. She's a real estate agent. Never been audited. I cross my fingers. So there's that. So net profit's what the IRS cares about. It also then shows you how much net you made each month at the end of that month. So as your sales increase and your cost of goods also increases, your margins get a little bit bigger because of your sales going up. In this case, all our expenses stayed the same. So look what happens. We're making more money as the months go by. Pretty cool deal, right? That's a fun thing to see. And then, of course, you get to the bottom line, which is the end of the year. And there are the totals. So this particular case, your gross sales was $19,700 for the year. You went all the way through December. You had cost of goods $39.40. Your net income minus cost of goods $15,760. Then you had your $6,000 in rent and all your other expenses come out. So you had a net profit on line 29 of $7,365.25. That is what you pay taxes on, okay? Excel spreadsheets do this in categories, separating them out individually by category. End up with the final result, same. It'll print out a final sheet that shows income minus expenses equals. And you can pull that if you're keeping it up to date on an ongoing basis, pull it anytime you want. You know exactly how much money you're making at any individual time if all the expenses and income are input on an ongoing basis. Okay? Does that make sense? Are there any questions at this point, David, at all?
No, but if you have any questions, feel free to type them into the chat and I'll monitor it and interrupt you as appropriate. How's that?
Wonderful. Now, let me see if I can get back to the screen we really want to get back to, which will be...
We do have a question. Can I expense mileage to business meetings in town?
Joe?
Yeah, okay, so if you are leaving from your home office to the business meeting, that's considered a business expense, so yes. You can expense to and to and from that meeting. Now, if you go somewhere else after the meeting and run a personal errand, then do not include any of those additional miles. Just the round trip.
Okay, next question. Where do you put the incoming information? That would go back to that spreadsheet, I'm assuming. But I'm not sure what we mean by incoming information.
Yeah, if it's income you're referring to, it would go on the total sales line, which is that top line.
Okay.
So if it's income that's being discussed, that's where it goes, total sales.
Okay. Do you have to document start and end mileage or just total mileage?
You actually, the mileage for the trip, you're supposed to document your beginning mileage, your odometer reading from the start to the end of the round trip, and you're supposed to actually make notation as to what it was for. That's according to the IRS. But does anybody do that? Probably not. I think the IRS says that you either need to track it that way or be able to recreate the expense. So most people, if they ever get audited, just recreate that. But there's ways to track it where you don't actually have to write down an odometer reading to and from, where you can actually use an application on your phone, like
yes, I've heard that too.
As soon as you get in, you hit click on that, and then when you're finished with your trip, you end it, and it actually tracks it for you through the GPS systems, and it's a nice third-party proof if you ever do get audited.
Okay, and what was the name of that app again?
Mileage IQ is one of them. There's probably 8 or 10 of them out there that you can usually pick them up for a few dollars or under $10 for the year.
Okay. If I have a business filed in Wyoming, no income or expense, do I have to file?
I'm sorry, say that again.
If I have a business filed in Wyoming and have no income or expense, do I have to file?
If you've not received I think if you receive under $400 for the year, you do not need to file.
Right, but you do have to file. I happen to have a business in Wyoming, and you do have to file a regular yearly annual fee if you have an LLC or a corporation in Wyoming. It's like a minimum of like $50 or something. But as far as an actual tax return, that's correct. Yeah.
Yeah.
Will it be the same Excel sheet if I use a sole proprietorship or LLC or LLC?
You can use the same Excel sheet. You just may need to add a few other columns for certain taxes that you're allowed to deduct. There's certain deductions that like depreciation is different from the federal to the state level. But each state varies there, and there is numerous types of depreciation that we don't really have time to get into right now.
Okay.
But if you'd like to set up an appointment, we can talk more about that.
Okay.
A couple points I'd like to bring up real quickly about the mileage thing. My wife being in real estate for 20 years, and her starting 20 years ago, actually 21 years ago, we didn't have apps. So she used a little pocket calendar in her car, little glove box thing, you know, her armrest glove box, had a pen in there. And she would use a tripometer bead on her car's mileage deal and write down the beginning and write down the ending, and would come up with a total number of miles that day. When she drove into the garage, she would, or started the next day, either way, pull out the little mileage thing, put her miles down, start it in, boom, go on to the next day. So she did it manually for about 15 years till the apps came out, and then it became a little easier to track. But yeah, so that way, in case she is audited, we have these little pocket calendars that we're going to produce for the IRS if need be. So.
We also have a little bit of a explanation on an earlier question. Do we have a daily sales, daily, monthly expenses that rolls up to the P&L from Excel? It seems to me if you're having daily sales or daily expenses, you'd want to do a QuickBooks.
I agree. I agree.
Yeah, I would agree too.
And Rebecca would also probably agree as well. Makes it a lot easier. The more technical the business becomes, the more it becomes, in my opinion, I think our all opinion is that you use some kind of tracking facility. It just happens that QuickBooks, we have a trainer here. She knows it inside and out. It is the most highly used small business software in America. There are others, but it's pretty cool. Once that thing's set up, boy, it's not that difficult to drive. That's the key deal.
And
this
we have
is really set up for, in my opinion, the mom and pop, the one person operation business, either operates out of a house or a very small rent situation, and not a lot of bells and whistles. So as we said originally, I think on slide 2, the more the bigger the business, the more intricate the business, QuickBooks is great. So,
okay,
guys.
Okay, we have a couple more. Let's see how we're doing on time. We've got one. Let's try this. Do you track mileage of employees, and how do we claim that on taxes?
Well, typically what you would want your employee to do that for you, and then reimburse them for mileage reimbursement. And then for the business itself, the expense is the reimbursement to the employee. Okay. Now the employee, if they are ever questioned by the IRS, they want to keep those records. It usually about 3 years. It could be up to 7 years, depending upon the situation.
Okay. Couple ones real quick. How do you enter a personal loan to yourself to start the business? And can you take draws back from that without needing to pay income tax?
Yeah, so anything, a personal loan from you to the business is just that. It is a loan. Now, if you are charging interest to your business, which most people do not do that, if you're charging interest to your business, the business can deduct the interest that you pay, that the business pays to you for the loan. However, you have to claim it on a personal level as an interest income. So most people don't do that because you're paying yourself and you're paying taxes on top of that. Right. So anything that you initially put in, a working capital that you put in, you can withdraw that tax-free because that is just a repayment of a loan.
Okay, one more, and then we'll continue on. I started as a service provider, but for future extension business and go into product provider to customer to research, if I travel out of the country, can it be part of the expenses? Travel out of the country. Okay, so
that's a question I get a lot, not just out of country, but traveling for more research. That's kind of a little bit of a sticky area. If it's just for research and you don't actually use the research in your business, then you technically cannot deduct that. Now, if you go to do that for research, or let's say you're going to a convention in Las Vegas, that should all be deductible because you're actually educating yourself more on something that's in your business. Now, if this is to start another division and you never start the division, technically that's not deductible. However, there may be ways to do that. But it's kind of that's a ruling that the IRS would probably have to make if you were audited. And my thoughts on that are, at all costs, avoid an audit. Do not even open yourself up to an audit. So that's kind of one of the things that I always recommend to my clients. You know, if it's a gray area. How willing are you to risk that? Because if the IRS finds you in fault or disallows that expense, usually that happens about 2.5 to 3 years down the road. And at that point, you pay an extra 45% tax through a 25% in penalties, and then about another 3 years worth of interest that effectively comes out to about 5% a year. Even though it's less than that, but when you compound that interest, it comes out to about an extra 40 to 45% you pay for that gray area if you are found wrong on claiming that as a deductible expense.
Okay, I'm going to put in Emily's email address in here, and if you have any other questions you want to contact Joe or Joe with any other more detailed questions or whatever, you can contact her anytime. I'm going to put in her address and let Mr. Dorko continue. How's that?
Okay.
Okay, what's up on the screen there,
my name is Joe Dorko. I'm the owner of Heavy Tax and Business Consulting. I'm also an SBDC finance consultant and small business consultant. I work out of the Finance Center, kind of based out of, it's a virtual center. I also work out of the Shasta County Center. So if you have any more questions in the future, you can always contact Emily and she can refer you over to me. I have also 30 plus years of running a business. I used to own a lot of rental properties. And I also have extensive experience in residential commercial lending. To kind of just give you a background on my background. And so I do a lot of consulting with businesses, and then I probably end up preparing their taxes for them. But we try to set them up so they can succeed. And that's kind of where we start there. And if we go to the next slide, Joe. Okay, so Joe started off with tracking expenses and why do we track our expenses? And I kind of want to continue on that and go a little more in depth with that. The reason we track this is, we have to track our income. And when we track our income, we have to know what is income. And so the IRS defines income as gross income as derived from whatever source, or income from whatever source derived, including but not limited to compensation for services, including fees, commissions, friends benefits, and similar items. What does that mean? Well, basically, if you're a business, pretty much everything you bring in for exchange of your service or your product is considered revenue. And we must include all of that into your income. Now, when we sit down to look at your taxes, or you sit with your tax professional to do that, they will tell you whether or not you can exclude that. But don't just automatically assume you can exclude it, because you said, say you've got this money from a source that doesn't look like it was an exchange of services. For example, grants were given out this year for business grants. Anything that's a grant really technically is not an exchange of services, but it may be taxable. So that is something you want to include, and you want to actually kind of line item list that out so that your tax professional can see that and can see if it's taxed at all, or if it's taxed at a different rate. So basically, anything you receive in exchange for your service or your product, whether it be cash received, accounts receivable, an IOU, or even bartered services, which is an exchange of your product for their service, or your product for their product, or your service for their service. Okay, so business expenses. Those are basically defined on items that are both ordinary and necessary to operate your business. And for an example, ordinary expense is one that's common to the industry. If you're in sales, advertisement's a common expense in the industry. And potentially also, say, entertainment, something like that is common to the industry. So that makes that what common to the industry makes it also a necessary expense. So it has to be both common to the industry and necessary to operate. And the best way to do this is to track your expenses as they occur. I don't know if you're anything like me, but if I don't track my expenses and try to go back at the end of the month, I have trouble remembering all of my expenses. So this is something you probably should do and be disciplined enough to do that daily, or even at the point of the sale or the point of the expense. And the best way that I know to use that is use the software that's available to you, whether it be QuickBooks, business apps that are on QuickBooks that pair with that, and use the technology that you have for tracking your expenses. If you don't use QuickBooks or an app like that, almost everybody has a cell phone these days with a camera on it. If you buy something and say you pay cash with it, before you leave that store, right there on the counter, take a picture of it and email it to yourself and put a note. This was for a business meeting. Something along those lines. So if we go to the next slide, Joe. Compiling business expenses. That is the using your profit and loss to categorize your expense so that they fall into an expense category that will match up with the Schedule C tax form. There is only so many different line items on a Schedule C, which we will bring one up here after a few slides here. And so when you want to match those up so that you're consistent with year to year where you put that expense. Consistency is one of the biggest things that I think avoids you getting yourself into a potential audit situation. So let's say that you have $10,000 worth of office expense one year, and your sales was $50,000, and your income was about the same at the end. And then the next year you have $1,000 worth of office expense, and then you categorize the other $9,000 somewhere else, say under auto expense. If your auto expense keeps going up and down, your office expense goes up and down, that I think sets off red flags for the IRS to potentially throw your business or your name into what I call the big hopper. And then they spin the hopper and they potentially pulls your name out for an audit. The very last thing anybody in a business sense wants is to be audited. So match those up well, put them in the right categories. And speaking about categories, Joe had kind of gone over cost of goods sold. And so I want to kind of define cost of goods sold a little bit better than that. So the cost of goods sold, in essence, is a direct cost that can be directly linked to the product that you sell. And for example, raw materials. Let's say you make a transistor radio. You're going to have the casing, all the transistors, everything that goes into that particular one radio. That's all the raw materials in there. That's a cost of goods sold. The labor cost to put that radio together, that's a direct cost. Now, it's going to exclude the indirect costs, such as overhead, or say you have a sales force that does not produce the radios, but they actually go out and sell them for you. That's a sales cost. That's not a direct cost to the cost of goods sold. So you want to kind of separate those out as direct, something you can tie directly to the cost of that material, of the product. And then the other ones that you would call just an overhead, whether, say I made 10 radios for the month and my rent was the same, my utility costs were the same, my sales force cost was the same as it would have been had I produced, say, 100 radios that month. So you can see that there is a variable cost there with the indirect cost versus the direct cost to the raw materials. And if we could go to the next slide, okay. And like I said, the next slide here kind of goes over what we were just talking about. The indirect costs are costs that are not directly attributed to the product. And here's a few examples of indirect costs. Your rent, office equipment, utilities, phone, mileage, sales cost, advertising, supplies that are not directly related to the product or production costs, commissions paid, insurance, home office, etc. So we can go to the next slide, Joe. Okay, and now there's some expenses that you get to deduct a portion of, but not fully 100%. So I wanted to kind of go over those, and these are a lot of costs that a lot of small businesses don't even take into account. Like, for example, food costs. Let's say that somebody had brought up an example. What if I travel to do some research for a new product? So if I travel, I think the rule is somewhere around another 60 miles from your home office. If you travel that far, you can deduct your actual food cost, but you can't deduct 100% of it. You can deduct 50% of it. And then if let's say you're an over-the-road truck driver, you're always going to be on the road. So they allow you, if you're in the transportation industry, to deduct 80% of your food cost. And so people either keep track of their expenses, keep the receipts for their food cost, and they add the total up, and then we deduct half of that. And I think the theory behind that is that you have to eat, either whether you're at home or at business. But if you're on the road, it's going to cost you 50% more to eat than it would be if you potentially just cooked at home. Now, the transportation industry gives you 80% reimbursement of the expense on that. So, a lot of people track with receipts, but that gets kind of, that's a lot of paperwork to handle. If you just track your days that you travel, because one, you are tracking your mileage if you're traveling. Two, you put potential hotels and everything else there. But if you decide that this is getting too labor intensive for me, there are something called food per diems, and it's based on per city or per county. Like say you're here in Shasta County, it may be around $59 a day that you get for eating. But if you went down to say San Francisco, that's a high cost area. I think they were reimbursed you around $70 to $72 a day. And again, you deduct half of that. Other partially deductible expenses, gifts, they may or may not be deductible. It depends upon if that gift was, kind of a requirement of making the sale or was necessary for making a sale. Say you're giving somebody tickets to a sporting event, and this may or may not be deductible, and it has to really actually say that this was really the reason that I got the sale was because I gave somebody tickets to a sporting event. Now, if you just bought tickets to a sporting event and you gave them to your client because they're a good friend of mine also, I like them, hey, I got these tickets I can't use. Those typically you cannot deduct. And the IRS has really been clamping down on this over the last 2-3 years. And then the other one I kind of wanted to go over is depreciation. That may be partially deductible. It's the depreciation is a whole nother area of deductions. And there are so many different forms of depreciation out there that it is an expense that you don't want to skip over or lose because it's an actual expense. But there's different ways that you can expense that. With depreciation, obviously the best way to expense anything is in the year that you spent the money for it. There's something called bonus depreciation that allows you between 50 and 100% deduction in the year that you spent the money on it. But those are set aside for certain items, big ticket items, something that's brand new. Usually you can deduct 100%. If it's used and you bought it, you may be able to deduct 50% the first year and then deduct it over the next life of the loan. Say it's a five-year depreciation schedule for, say, an automobile. You would depreciate it over the rest of the remaining balance over the rest of the life of that piece of equipment. So, Joe, can we go to the next slide? Okay. All right. So let's go over a few non-deductible expenditures: bribes, most lobbying costs, penalties and fines, and political contributions. Some people, well, number one, in this country, bribes are illegal. But if you do business overseas, there's this one little caveat in our actual tax code that allows you to deduct bribes in China, if you did business in China. but it has to be the official above the lowest official. So like in if you try to bribe the local deputy sheriff there, that's not deductible. But if you bribe the sheriff and they change the law for you, then it's deductible on our taxes here. Kind of an extreme example, but I always like to throw that out there so everybody can see the difference there. Most of your lobbying costs, not unless the law changes directly because of your lobbying, it's not deductible. It's like your big pharma industries, they spend a lot of money on lobbying, and some of it used to be deductible, but I think they've actually kind of pulled back from that also. So most of your lobbying costs are basically not deductible expenses anymore. Penalties and fines. So let's say you have taxes that you didn't pay your taxes on time, and you decided, well, okay, I didn't pay any quarterly taxes throughout the year, but at the end of the year, on April 15th, I wrote my check for what I owed for the taxes. Well, there's some penalties and fines for not paying on time your quarterly taxes. Those penalties and fines are not deductible. However, the taxes you pay may be deductible on some level there. And of course, political contributions, those are non-deductible expenditures. Joe, if we go, okay, all right. So when I look at preparing people's taxes and trying to give them some tax planning advice, our goal here is always going to be to maximize gross income, the money you bring in, and minimize the tax that you pay on that gross income. So it's key to know what tax advantages of the loopholes and deductions you can take. A lot of small businesses, especially ones starting out, do not know what's deductible, what's not. And sometimes it gets so overwhelming that they just don't even track the expenses that they can deduct. So sitting down with a good tax planner and doing some strategy a couple times a year it's a really good idea to do that. That way you know what you can deduct, what you should track, and you know what you can and cannot spend money on. For example, going back a few slides when we were looking at the entertainment, you got to know what you can deduct and what you cannot, and that allows you to make a decision whether or not I should buy tickets to a sporting event to give to one of my potential clients or not. That gives you an idea what you can and cannot do, and it's always good to get a good refresher or reminder on that. Another thing that a lot of people in business do not take advantage of is tax credits. There's a lot of business tax credits out there. There's a whole long list of those, which I won't go into, but that's, again, tax planning. You could sit there and talk about what you do for a living with your tax planner, and your tax planner should know, hey, there may be some tax credits. Let's look into this for you. And then if there are some tax credits, why not take advantage of that? Because the way I look at that, that's money you're leaving on the table. And then other ways, looking to defer taxes, 401k plans and other deferral plans. There's different types of 529 plans that you can take advantage of for your employees, for yourself, health tax plans that are basically like an IRA, a health IRA, and other items like that. So those are things to look into. All right. So kind of to conclude what we've gone over here in a seminar between Joe and I is, it is really key to track your expenses. And if you use software and phone apps, it gets a lot easier. Plus, you look at this as almost a third-party proof. If you're ever audited, you almost have a third-party proof or a timestamp saying, hey, I tracked my expenses here. And if you get into a situation where you're in an audit, you could show the timestamps when you did this. Even if you're missing the receipts, you may be able to actually get the IRS to approve some of the stuff that you don't have receipts for if you've actually lost the paper or physical copy. Running your profit and loss at least quarterly, if not monthly, is at a minimum is what I recommend. I know Joe says he likes to look at it weekly. Which is, if you have the time to do that, you're probably going to be more profitable. You're going to know where you're making your money, where to focus your efforts on, and where not to focus your efforts on. The other thing I want to encourage you to do is pay your taxes on time. Don't try to plan on getting caught up at the end of the year. As if, there's a rule with when you buy anything, either versus credit versus cash. If you don't have the cash today, there's a good chance you won't have the cash in the future to pay it when the bill comes due. So it's best to pay your taxes on time and plan for that. Plan on knowing how much you're going to make, how much your expenses are, and we can kind of roughly estimate how much you're going to owe at the end of the year based on what you're currently doing. So then we're going to go ahead and say, okay, well, you need to put, $4,000 down on your federal taxes and $1,000 on your state. So, plan ahead and it won't be a big surprise come tax time. And like I said, sit down with your tax specialist a few times a year to look for strategies to avoid or defer paying taxes. Look for credits, take advantage of the tax laws and the loopholes. And always remember this, making money is easy. Keeping it is always going to be the challenge. So, and now I think Joe and I was something that we wanted to do was go over Schedule C for you guys to kind of give you just a quick overview of what a Schedule C looks like, and where you should be tracking your expenses and categorizing them so that at the end of the year, if you prepare your own taxes, it'll be a lot easier for you. And if you don't prepare your own taxes, the more organized you are for your CPA or your tax specialist, the less time they have to spend going through your box of receipts, the less they'll charge you. So Joe just brought up the Schedule C here. And if you're not familiar with that form, it's on the IRS website. You can pull one up yourself, or I think this one might be available to you also through the slides here.
Yeah, as a matter of fact, we'll make sure that you get a copy of this in blank when we send out the information to you at the end, a couple days after the end of today's class.
Mm-hmm. And so
these figures are the ones that came off of that old Excel spreadsheet that we did about a half an hour ago. Utilizing that Excel spreadsheet information, this is how it fits on the Schedule C.
Yeah. So, I mean, you can see there that, all the income went one section. There's a cost of goods sold there on the top, part one. That actually comes from page 2. It's a little worksheet that you fill out on page 2.
Yeah.
And then you categorize all your expenses there. So we didn't actually fill it in, but right here is the cost of goods sold. And then that transposes to the first page. But then you kind of group your expenses. And like I said, consistency is the best way to stay out of an audit. If you had your office rent was $6,000 for the year, and it's $6,000 next year, put it in the same location. Don't call it office expense when it was rent expense. Stay consistent with that. Call your office expense, and anything that doesn't really list out here, like your advertisement, depreciation, legal, professional services, taxes, license, all that. There's a category on the bottom there on line 27A, and it says other expenses. And if we go to page 2, Joe, if you kind of scroll down through that, it gives you a list of where you can actually handwrite or type in there what that is. Like, let's say, for example, you use your cell phone for business also, your personal cell phone. And let's say you use 80% for your business, 20% for personal. Well, you should only deduct 80% of that. So what I always like to type in there is business use of personal cell phone times 80%. And then I put the 80% figure out here to the right in the dollars and cents column. And then you can list other things out there, anything that's an odd expense that wouldn't normally be a standard expense. Then you would kind of list it separately there. And that way, if the IRS is auditing you from one year to the other, they can look and say, okay, why were the expenses much more here? And then you can list out these odd expenses that then it reassures them, well, maybe this person's doing things right and we don't need to audit them.
And the line I would like to bring up, and I know Joe would too, is line 31. Everybody needs to know what line 31 means. Net profit or loss, line 31. That's how much money you made in that business to report to the IRS at year end. That's the number. And we faced a situation all year this year with the disaster loan financing and any of the grants that were being offered for small businesses in our community kept asking for line 31 figures. What is your net profit? So that's a magic number that means how much your business actually netted in the year in which this tax was reported. So, and when I used to make loans, I used to have a situation, I always like to bring up this analogy real quick. And that is, I'd have a customer come to my desk at the bank and say, Joe, I had a great year. I sold $1 million worth of stuff. You know, I had sales of $1 million. And I'd say, congratulations. What was your net profit? Oh, 0. And of course, then they come in and say, I want to borrow money. So there's a little catch-22 here. The catch-22 is if you write everything off and you show nothing at line 31, puts you in a disadvantage if you need to borrow money or if you needed to apply for these disaster loans. So there's a weight that we have to, we call it a balance between, yeah, you'd like to write everything off so you don't pay any tax at the end of the year. That's be great. But what if you got to borrow money, new piece of equipment, you know, you need to expand, you need to, if I needed to get an office space, I better sure as heck have some money here to prove I can get that office space or whatever it is I need to buy. So it's kind of one of those catch-22s.
Yep, and that goes. That's the same for if you're buying a home,
right?
And they look at that figure when you're buying a home. So ideally, you don't want to pay taxes, but again, talking to your tax professional and planning ahead and say, hey, I'm going to buy a house in 3 years. You need to start showing income or you won't qualify for the home based on just, you know, your income through your small business. So those are a lot of things you want to consider. And you know, tax planning and strategies is not something you do for just for the next 3 months. It is something that you want to plan for several years down the road. You know, you may even say, hey, you know, my goal is to buy a building for my business instead of paying rent. You need to qualify. And those are usually 3 years worth of personal and business taxes they want to see. So those are a lot of things to consider. And like I said, when you plan, you know, you got a plan and then it's just working towards your plan.
Are we seeing the conclusion screen again?
Yeah.
Yeah, we are.
All right, question time.
We do have a few here. Let me go through them real quick. Our friend Nina is asking Mr. Dorko, would you talk about some of the main factors to consider when changing from a sole proprietorship to an LLC? Okay, we were probably going to have a class in the future on that, but I can kind of give you a couple the quick answers on this. Is the reason I recommend people move from a sole proprietorship to an LLC or an S Corp is there are some tax benefits for it. There is some negative sides to it also. And the negative sides, I'll go over those first, is the reason you go into an LLC is it gives you legal protection from, let's say you have a partner and they do something illegal. They're only at fault for the percentage of the business that they own. You're not at fault for that. The other part is there, you know, on the negative side of that is state of California charges quite a hefty fee for you to do business as an LLC or an S Corp versus a sole proprietor. It's a minimum of $800. And on top of that, you have to pay for a tax return for the LLC and pay for a tax return for your personal,
Whereas with the sole proprietor, that's all done on your personal tax return. For example, I charge about $550 for the business tax return. And it varies. If you got a smaller business, I charge less. If it's more in depth, I charge more. And I kind of base it by the hours there. But so you're going to pay $800 at a minimum for the franchise tax board fee. You're going to pay somebody like me an extra $550 for that tax return above and beyond what you would normally pay for your personal taxes. And so they cost a lot more money. Now, there are benefits for it. When I can get into that in a second, but the biggest reason somebody jumps to that is for the actual benefits. But here's something that in between, if you don't really have many assets in your business or even personal assets, stay with the sole proprietor and go get a business insurance policy for $2 or $3 million. If you do something wrong, you have an insurance to cover that. That business insurance policy could be between $200 to $500 versus the $1,300, $1,400 additional you pay for having the LLC. Now, that being said, if we move to the LLC, there's some benefits there as far as paying it for insurance, health insurance. There's also some benefits for taxes that, let's say you are only work half the business and the other half of that money that you have in your business is more of an investment into some business. So let's say you as an investor could have invested in a different business, but you decided to invest in your own business. And you work 50% of it, you pay somebody else to work it. Well, the full 100% of income from that, you on an LLC, you probably wouldn't claim the full 100% of income as business income. You would consider a portion of it as business income and a portion of it as investment income. There's different taxing rates on that. And the example there is when we went back to line 31 on the sole proprietorship, that's what you pay tax on. So as an employee of your own company, an employer and an employee of your own company, you pay 15.3% tax on that dollar before it transfers over to your personal side of the taxes that you pay ordinary income on. So when there's some benefits for that, and like I said, we don't have enough time to really get into that far in depth. But there, if you do have additional questions, get a hold of Emily, and she'll make sure she can get you in touch with me, and we can kind of go over that all through the SBDC training. And again, that is no cost to you. So I would encourage you to get a hold of Emily, and she can get you to the right person to help talk through this.
I put a link in the chat. We would appreciate it if you'd take advantage of that link. It's a survey to talk about. Give us your feedback on this particular webinar. We have thick skin, please be honest. And you will be getting that link also in an email along with the spreadsheet, link to this recording, the presentation, the Schedule C as well. I'll continue to ask these questions. If you need to drop off, we understand, but please do provide that feedback. That really helps us try to make these better, and we use it. And appreciate your help there. Is the idle considered an income or an expense?
The idle itself is a loan. So it's a loan that you pay back. Now the expense portion of that is a service fee, I think, that they charged up front, plus the interest you pay on that. But the actual money that you borrowed is not an expense. That's just you borrowed money, so you're paying that back. So let's say, for example, your payments on the loan was $1,050, and $1,000 of it was principal you paid back, and $50 was interest. Then you get to deduct $50 worth of business interest on that.
Good, thank you.
If I could add an add-on on that, Joe, do you know, has the idle grant been classified, and does that have to be reported somehow?
That I do not know AICPA, the governing body that basically all the CPAs subscribe to, is working closely with the IRS right now. So we don't know if we have a ruling on that. And I almost expect that ruling to come out around somewhere around mid to late January. That's usually when the IRS comes out with the temporary rulings. However, with other grants that I've looked into, they are taxable. So, you know, the good news was it was free money, but you do have to pay tax on it because they consider that income on other grants. So I'm almost assuming that let's plan for the worst on that and call that is going to be considered income.
Okay, good. If I'm a full-time employee and a sole proprietor and provide a service, how much is the tax and what is the tax bracket for a home-based business?
Okay, so tax brackets are based on income amount or adjusted gross income. And that is basically after all of your deductions, personal, business, everything else there. Your tax bracket is based on the amount of money you made. If you're single, head of household, married, filing jointly, or married, filing separately. That's what it's based on, is how much reportable income that you have. And now the business portion of that, like I'd mentioned, so every dollar that you receive on a small business, you pay a minimum of 15.3% in a self-employment tax. And that is basically the employer and the employee portion of the Social Security and FICA taxes there. But to look at it this way, if you own a small business, 15.3% of every dollar that you earn, the net profit, you will pay 15.3% tax on that. Plus, every dollar that you made that transfers over to your personal side of the taxes, you're going to pay whatever your tax bracket you're in. Say you're in a 10% tax bracket, you're going to pay 10 cents on that dollar. So in essence, for every dollar you made through your small business, you're going to pay 25.3% of that dollar. 25.3 cents of every dollar is going to be paid to the federal government. And then you have a state tax, whatever tax bracket you're in there, which could be up to, I think it's up to 11 or 12%, depend upon what state you live in.
Good, thank you. Let's see, how could I leverage opportunity zones to pay less taxes?
Getting into the opportunity zone, those are more of a tax credit. With the opportunity zones, that's something we'd have to probably talk about a little bit more in depth. Maybe schedule a time with me on that through Emily, and okay, we can kind of go into that a little bit more in detail.
Yeah, and remember that would be a free session. Our services here through us are all paid for. Do you need to have a Schedule C for each business, or can it be consolidated? And one of the businesses is a corporation and one is a sole proprietorship.
Okay, let me see. So if you have two businesses and they're both sole proprietorships, technically you're supposed to fill out one for each. I have seen, and I have done it too for some of my clients, that like they had a small business where they sold jewelry or something and they made 20 grand right the year, but that wasn't enough money to survive on, so they went and did Uber in the evenings, but they made $600 on it. We just grouped it all together and I called that other income. But technically, yes, you're supposed to do a Schedule C for each business. The reason I did that was to save them a little money on tax prep. I figured at the end of the day, you still paid the same amount of taxes to the IRS. They could split a little bit of hairs on that, but I wouldn't go through the whole process unless your business is making, each business is making a considerable amount of money. That's just me personally. And now if you have an LLC and an S Corp, or an S Corp and a sole proprietorship, say you got three businesses, each one is its separate entity, meaning you need to prepare a return for each one.
Right. Okay, I think that's it. Thank you, gentlemen. Like we mentioned, you'll be getting an email with a spreadsheet, link to the recording, the presentation, Schedule C, and a link to the feedback. And very much appreciated if you would fill out that survey. Thank you, Joe, and thank you, Joe. You guys were terrific. And thank you, everybody, for showing up.
Yeah, thank you for attending.
All righty, take care.
Have a great day.
Have a great day. That's sure.